What I saw was very interesting as the credit crisis unfolded. We had always had there was always a delineation between the fixed income investor community and the equity. The fixed income side of the house was very much focused on cash flow, credit metrics. The equity side, who represent the preponderance of analysts that we see and who knock on our door, they're more interested in the dividend, in EPS growth, top line growth, what's going on within your business. In our case, our interactions with the regulator. But what we saw as the financial crisis became more acute was the equity side start to adopt the thinking of the fixed income side. So suddenly from the equity side of the investor community, we were getting questions and a lot of focus on cash flow, balance sheet, credit metrics, your credit rating, your access to lines of credit. They had moved from top-line growth, because there was no top-line growth, to survival. Do you have the cash, either from internal operations or from existing lines of credit, to survive the next quarter, the next 6 months, the next year? Could you finance your business in this kind of environment? And how long? So it was a very, very interesting dynamic.
We continue to really work hard to be responsive to investors. We made our management team as accessible as possible. We kept our story and our strategy up to date regarding the impact of the credit crisis and any adjustments we were making to that strategy to be responsive to what was going on in the environment. So I think really just being very closely in touch with the senior management team, very closely in touch with our sales force, who understood exactly how the changes in the economy were impacting decisions to buy, whether that meant that, purchasing decisions were actually shortening for some reason, which would affect our bookings, whether people were choosing to make fewer commitments to the company in terms of their purchasing patterns, and being very proactive about communicating that was a big thing.
We did change our messaging. We developed a presentation that was more oriented to the fixed income crowd. And this became the universal message. We had always interacted quite a bit with the Treasury Department because they are the group within our organization that deals most closely with the rating agencies. But during this period, we were just together, side by side, the whole way through. The slides that were in our basic presentation were more the slides that they would have in a credit rating presentation. So it took on a more financial metrics direction in terms of our presentation and our story. We happen to be the longest continuously listed stock on the New York Stock Exchange. We were first listed as New York Gaslight in 1824, and we've been continuously listed ever since then. We've missed one dividend during that period of time. That was in the early 1970s, and we've increased our dividend for each of the last 35 years. There are only two utilities in the S&P 500 that can boast a record of more than 30 years of consecutive dividend increases. So that kind of, I should also mention that we are described as the classic widows and orphans stock, a high dividend payer, steady as you go, very attractive to the retail, the individual investor. And we are 57% owned by individuals. So during the crisis, we had more and more institutional investors seek safety in our name. They were looking for reliable dividends. They weren't getting paid in terms of capital appreciation because the market was just going down day after day. So they were looking for dividends. And part of our story has always been the safety of our dividend, the safety of our company. And that continued to be a cornerstone of our message throughout the crisis. It used to be I would get a call every Friday afternoon from our specialist who would give me a wrap-up of the week's trading. What kind of volume we were seeing, what kind of block trades we were seeing. Today we need more real-time information. The market, the trading has become so sophisticated and so fast. We're talking nanoseconds now. We're in an era where trading houses are locating their servers in geographic proximity to servers of exchanges so that they can take advantage of a millisecond difference in time. So the need for real-time information is it's not an understatement to say that it's acute today. And the demands on the investor relations officer to provide this kind of data to senior management is critical.
Because the financial analysts and institutions have significantly had to reduce headcount and staff, the role of investor relations has become one of being required to be way more proactive about the communication and very, very clear and specific about what we are trying to communicate. Because investors have little time, and sell-side analysts who are trying to cover anywhere between 18 and 25 companies, sometimes with just one assistant and associate, do not have a lot of time to spend on one specific story. So our goal is really to make our story as easily digestible and clear as possible, and then to be very proactive about following up with those individuals to make sure that the message that we're trying to deliver has gotten across, because they're just too busy and they have too many demands on their time to really be able to stay up to speed without us being really proactive about the process.